Hi, Vincent here from The Simple Dollar, and in today's video, we're covering a question from one of you guys, and more specifically, how does inflation affect a mortgage? If that sounds good, make sure you smash the subscribe button and ring the notification bell to always get the latest and greatest from The Simple Dollar. And remember, you can find great content like this and even more by visiting thesimpledollar.com. So firstly, let's start off with the actual message that we received. My brother has argued with me that I shouldn't make any extra payments on our mortgage because we're losing money over the long term by making early payments. He said that with inflation at 3% and our money able to earn 1% at minimum in a savings account and more if we do other things, we're losing money by making early payments on our 3.75% mortgage. What do you think? So from a purely financial perspective, your brother does make some good points. However, your brother's case has a lot of implied assumptions that might not necessarily hold true for your situation. So for example, let's say you get a raise at work that is equal to the rate of inflation. Since your mortgage payment stays the same, assuming it's a fixed mortgage, that means your mortgage payment will take up a smaller and smaller percent of your actual income. With the percentages expressed by your brother, your mortgage payment will take up only about a third as much of your income by percentage during the last year of your mortgage versus the first year. So let's actually use real numbers. Let's say your monthly mortgage payment is $1,000 and your annual income is $30,000. Right now, you're paying around $12,000 a year for your mortgage payment, which is around 40% of your take-home pay. Each year, let's say you're getting a 3% raise, and after 10 years, your annual income would be a little over $40,000, which drops your mortgage payment to around 30% of your take-home pay. After 20 years, you'll be bringing in around $54,000, which drops your mortgage payment percentage from your take-home income down to 22%. During the last year of your mortgage, you'd be bringing in around $72,800, and your mortgage payment will take up around 16% of your take-home pay. The argument against early payments is that it doesn't make much sense when your mortgage payment takes up around 40% of your take-home pay to pay more so you can reduce or eliminate the amount of mortgage payments you make when the mortgage payment takes around 16% of your take-home pay. Although this is a pretty powerful argument, it does forget a few key points. First, it assumes that your income increases at a rate of inflation or even better. However, the truth of the matter is that wage growth is not keeping up with the rate of inflation, and even in some industries, it is actually seeing a negative growth. Secondly, most Americans can't rely on the assumption that their wages will increase every single year. That's just not reality for most Americans out there. Next, it assumes that you can make a sizable return from a small amount of investment. If you have $5,000 sitting in a bank, you can probably find a really great way to earn a return of 4% or more. However, that's just not the reality for many people who have $1,000 in the bank. If you have $500,000 sitting in a bank, then sure, you might be able to find some way to get some really great rate of return, maybe even 4% with that bank. However, it's much harder to do when you only have $1,000 in the bank. Most Americans just don't have capital on hand to purchase rental property. In fact, most Americans don't even have enough for an emergency fund. With an extra mortgage payment, a person could get a steady return of 3.75% from every single dollar they pay ahead in their mortgage. Next is that it assumes a rate of inflation. The CPI, which is a measure or a tool to estimate the rate of inflation, indicate that it has only touched 3% once in the past several years. In fact, the rate of inflation, according to CPI, is generally around 1.5 to 2%. Most inflation-based arguments rely on an inflation rate of 3% before making financial moves according to that rate. Finally, it assumes inflexibility. If you're in a position where the rate of inflation is 5% and you can make 6% in the savings account, then it makes sense to put your money in the savings account and make minimum payments on that 3.75% mortgage payment. On the other hand, if your savings account is only paying 1% and with an inflation rate around 2%, then the perfect solution might be a little different for you. Just because you choose to make early payments now doesn't necessarily mean you can't do something differently later on. As always, thank you so much for watching. If you have any questions about this video, feel free to leave a comment down below and we'll get back to you as quickly as possible. And remember, if you enjoyed this video, to smash that like button and smash the subscribe button to always get the latest and greatest from The Simple Dollar. And remember, you can find more content like this by visiting thesimpledollar.com.